Welcome to this week's Fireside Chat with Jesse. I am joined today by Dale Kluga, President of Providence Equipment Finance. Thanks for joining me, Dale.
Oh, thank you for having me, Jesse. I really appreciate it.
No, I appreciate your time, sir. It was great catching up with you in person a couple of weeks ago at the funding conference in your backyard. Typically at the event's always in April, so the March timeframe kind of threw us off a little bit, but it's a great conference.
Just like Silicon Valley Bank's failure threw us off too.
Yeah. Yeah. Would that happen like as we were almost on planes to go to this conference to talk about funding? All that planning that these people did for all their panels and everything else. And now it's like, I think we need to pivot and make sure that we're having the right message here.
Sure.
Dale, for those people who might not be familiar or they haven't had the pleasure of meeting yet, do you mind just kind of introducing yourself and your career to date in equipment finance?
Sure. So I'm president of Providence Equipment Finance. It's a division of Providence Bank and Trust. We're a $2 billion bank out of the Chicagoland area. The bank bought Cobra Capital, the company I started in 2000. They bought in 2016 to expand their commercial lending products into leasing on a national level, diversify a little bit geographically as well, and generate some fee income, which we do as our principal model.
And how long have you been in the industry?
So I've been in this industry a long time, Jesse. It's been 42 years. I started at Continental Bank in 1981. I'm a CPA by background, so I started in the management accounting group there. I always wanted to get into small business of some type. My family was into small businesses. And so I figured starting out at Continental would give me a good education from an accounting perspective, a finance perspective. And so I entered into their IT and accounting program in 1981, went through that for 3 years. At the time, Continental was a pretty good sized bank. We all thought we had it made, getting a job at Continental because they were lifers. And when I joined in 81, it was, I think, the largest bank in the Midwest, the third largest or fourth largest in the country. And within 3 short years, it became the largest failure of any bank in U.S. history. So it was a real challenging time. It pretty much forced us all to learn how to survive and learn new skills. So I think it's fair to say that I started out my banking and leasing background with a bang. And while it sounds disastrous, it actually opened up a lot of opportunities for us.
Sure. And then after Continental, I was actually going to bring that up. It's like, well, you learn what to do and potentially what not to do. But because I've had a few people mention that name, and I was born in 81, so I was not familiar with that until some people brought it up.
That puts it in perspective. Yeah.
Puts it in perspective.
Yeah, it was a really interesting time back then in 1981. We had record inflation. In fact, there's a lot of similarities to today's environment. Just like 40 years ago, we're in, the worst inflation we've had since 40 years ago. And in addition to that, what's also kind of interesting is when we saw the Silicon Valley Bank failure, which was like the weekend before we had the Alpha conference in Chicago, the funding conference. When we saw that happen, it brought back memories because Continental failed for very similar reasons. We concentrated our overnight funding with correspondent bank deposits. And all it took was one false news story out of Europe that our bank had filed bankruptcy, which was not true, to cause all kinds of havoc and a bank run on Continental. We didn't have the same exposure and unrealized losses on securities like Silicon Valley and some other banks do right now. But what we had was just a massive run on the bank. And we had a fraud that took place on not a material scale, by the way, but it took place in Oklahoma City at Penn Square Bank, where one of our executives who had full authority to run the operation took some bribes. That's really what started the whole process. But from the perspective of assets, our assets, we had 42 billion in assets. They were extremely solid, just like Silicon Valley's securities that back up those investments that are below market rates right now, those are solid as well. So it was a funding crisis that caused both banks to fail 40 years apart. So it just goes to show you that, capital doesn't really determine how a bank will survive or if it will survive. Liquidity is always the case. And, that's something else I've learned, starting a couple leasing companies. Liquidity, cash is king. And I think, the regulators were, some indications say that the regulators were aware of it, but they didn't take action at Silicon Valley Bank to do something about it. Well, it was too late.
Sure.
And of course, I did write an article called The Triple Threat, and it talks about the three issues in banking today. One is obviously the low rate securities, investment securities in the 2 to 3% range, and the overnight funding that Silicon Valley and other banks are doing above that at higher rates, which creates this negative spread. So, I don't think it's that relevant as to what kind of securities you have, whether they're for sale or hold to maturity, because if you're going to lose money as a bank, all that money is going to flee out of the regional and the community banks to the systemic trillion-dollar banks. And then we have a problem. So now this week, it seems like the stock market has recovered, and the general capital markets feel that it's not a systemic issue. But I'll just remind everybody of this. The weekend before Alpha, it was also viewed as a single event, and it was not systemic. During Alpha, by Wednesday, suddenly other banks started to fail for similar reasons. So then it was popular comment to say that it was beginning to be looking like it was systemic. And now here we are a couple of weeks later, and the press is covering it as if it's not systemic. I still think there's some real issues buried in a lot of bank balance sheets that no one realizes. And if the Fed continues on that path of increasing interest rates, like they've said, earlier this year, that's going to make the spreads worse for all these investment portfolios. So, the most recent comments I've heard is that the Fed may only increase another 25 basis points in May. And that would be a great sign, because I personally think the Fed went way too far. And it set us up for this kind of hard landing. And this is just one sign of it. So I guess it all really depends on the Fed. You can't bet against the Fed, right? That's what everybody says. There's no reason to, because you don't know what they're going to do. But, they misread the market, a year or two ago when they classified it as transitory. And I really think that led up to this whole situation. I'm not saying it caused it. I think the excess money that was put out to the public markets during COVID, I think all that liquidity funding, we're dealing with that today. You have to pay back money one day or another. And now is the time where I think it's hitting our economy. And I really think that's the true cause of what's happening here. The Fed's just trying to manage around it. So, but yeah, it's interesting. 40 years later, history repeats itself.
No, I mean, cyclical. I've been in equipment finance since 2005, so I've really only experienced what do they call that? The Great Recession. Yeah. But that was like 4 years in, and I think that was early on, and it's kind of really been just like this pretty much until recently. So I think a lot of the younger generation is kind of in my similar situation where like, what does this really mean? Right. What are we looking at here? How long is this going to last?
Well, it's interesting because when we have a downturn like this, it creates a lot of opportunity. And I will tell you that sure. I started two companies. When I started LaSalle's leasing business, LaSalle Bank's leasing business in 93. 93 was okay. It wasn't that bad of a situation. In 96, when I started Galco, Great American Leasing, it was 3 years before we had the small ticket leasing crisis in our industry. And so, there was 3 years of growth, and then we hit the small ticket leasing crisis. And Great American Leasing, or Galco, was a small ticket lessor. We were doing average deals of $10,000 to $15,000. And when the dot-com crisis hit in 1999, that created another opportunity. And in 2000, I started a new company. I sold Great American Leasing to go into the lower end of the middle market, which is really what my background is, lending to small and mid-sized businesses, the lower end of the middle market. And so when that occurred, it created just a tremendous opportunity in the year 2000 to start Cobra Capital. And those opportunities, are what you're going to see when we have these cycle changes. And, in 2005, the year before or 2 years before the Great Recession really started, that helped launch Cobra. I mean, we picked up a lot of business. We really were very selective about it. And in 2007, we saw a lot of our community bank investors getting too heavy into commercial real estate, unsustainable loans at ridiculous values. The subprime mortgages were being issued and being bought in the markets. And so we got nervous. We paid off all our lines of credit in 2006, the end of 6, and we basically lived off the portfolio until the crisis subsided a little bit within 2 years. So for the next 2 or 3 years, the reason why we survived the Great Recession and actually flourished through it is because we deleveraged. And I really think that's something that's different today. I think a lot of leasing companies today are well capitalized, much better than they were before the Great Recession. And I think it's true. Our banking industry is sounder. They've cut back on the subprime unsustainable lending. We have a different financial issue in the banking system with the investment securities and interest rates with the Fed. But nonetheless, I think that, every time there's some kind of change in the economy, it creates opportunities. And that created the opportunity to start Cobra in 2000. And it created it once again after the Great Recession effects subsided. We jumped back into the market in 2012. We grew. And then I sold the company to Providence Bank in 2016 because they wanted to participate in some of that growth. So you're going to see it. Everybody that's in this business will see these cycles. And, looking back 40 years, I know it sounds like a long time. It went really fast. And that's a good sign because it means you enjoy what you do. But it was literally, I think, we entered the market. My generation entered the market in the most volatile time for the next 40 years because we had a recession almost every 5 years, with the Great Recession being the worst, of course. So, there's a lot to learn from volatility. And, that's one thing that my mentors really deserve all the credit for any success that I've had to date, because they helped me manage through those processes. And those were very challenging times. Every time you hit a recession and you just didn't know when it was going to come, but it's the same skill set that you can use to adjust to any traumatic change like that. And you can apply that every time. And so that's one benefit I did have is no way did I think I was going to have, 40 years of recessions every 5 years. But I learned from it. You got to make mistakes sometimes to learn, really good lessons. And as long as you realize the mistake you made and try to counteract that by using these lessons our mentors have taught us, it's invaluable. You can't get that from an MBA program. You can't get it from a PhD. Learning in the trench is, what I am all about. And it's humbling, very humbling to know that, these things can happen. And it makes you more risk averse as you get older. There's no question about it. But it also helps you recognize and screen through opportunities that maybe aren't as good as you think they will be. So, it's a balance. I started out pretty aggressive as a lender in the 80s, because that's, the go-go 80s. But we learned our lessons. And, the time that I did spend later in my career working in workouts, I ran the workouts for LaSalle before Norm Bobbins, the president and CEO, the best banker, I think, in the country at that time, before he allowed me to start the leasing company. So it was a carrot and a stick thing. Here's the carrot. You work out all our commercial workouts and do it within, 2 to 3 years, and you'll get the opportunity to start a leasing company at LaSalle Bank, which is what happened. And that was really, a stepping stone. And for those people that want to get into the leasing business and want to start their own company, the first thing I would recommend is get a good, solid education. Build your foundation, build that footing first, from a training program with an institution that's high quality, and then start building your network. And that becomes part of the foundation before you put the building up. And so you develop that footing and that foundation. you're going to be ahead of the game because you're going to understand a lot of things that other people don't understand when they just jump in. If you're a salesperson, you want to start a leasing company. Well, that's great. You got a network, but you got to run the business. And you got to anticipate.
Sure.
And, anticipation, I think, is the one thing that my mentors taught me that was the most valuable skill set. And anticipation for me was based on history. So, there's signs that repeat themselves in each of these cycles. And sometimes they're not, obvious, but pretty much every down cycle that I've gone through over the last 40 years, there were signs to every recession that came about, and it was similar to the prior ones. So, in our current situation in the industry, I think one of the things that has created a problem for pricing, not getting into the credit side, but just on the pricing side and the compressed margins, is because there is so much money still floating out in the system. And a lot of that came from the COVID subsidies. So, until that normalizes, until we pay that money back, and until we start growing the businesses, the margins are tight, and they'll remain tight. Now, the Fed thinks that their interest rates and various other issues are going to help him slow down inflation, and that's going to create more unemployment. It's going to create a credit freeze. In fact, his last speech that I listened to, he anticipated that there will be credit tightening this year, particularly on small businesses. So we've learned our lesson from the Great Recession. I think all of us know that when and if we should deleverage as operating leasing companies when we're borrowing money on warehouse lines or funding ourselves with equity. And I think we are so much better capitalized today than we were during the Great Recession. The Great Recession was full of horror stories of banks that were undercapitalized and just started pulling lines of credit on a lot of our associates, a lot of people in the leasing business that had warehouse lines for no good reason. They were not in default. It was just that the banks didn't have the capital to fund those warehouse lines. So, Alpha just put out a survey, and I'd encourage everybody to complete that survey. And it's a survey about how, if you think you are going to be affected, if you are already affected by these bank runs and the tightening in the capital markets. So that's one thing I would encourage everybody to do, is take a look at that. Some of the discussions we had at Alpha were just really fascinating. We never talked about stuff like this before, but I believe our industry, because it's so much stronger than it was, and it's becoming more of a recognized industry in the capital markets. I'm not going to say top tier, but near the top, which it was never at in the 80s and 90s. So I think we can sustain this, and I think this is an opportunity for our industry to elevate itself publicly, to demonstrate to the country how well we support small and mid-sized businesses, which make up 60% of our GDP. So, this is a great opportunity for us to show the entire world and our country, of course, how strong we are, that we have discipline, that we know what we're doing, and that we can assist. During the Great Recession, I went on TV and radio, and I talked to many politicians, many congressmen, senators, and I was offering up our industry to assist them rather than to bail out these $1 trillion zombie banks. And my opinion was we should diversify the banks, break them up, make them smaller, because they'll be better managed. But of course, that didn't happen. And a lot of that is political and lobbyists and so forth. But I offered up our industry as a solution to the Great Recession and, the punishment that the small businesses were going through. And there was no real political support for that. So, it was a shame, but I think the politicians in Washington maybe can remember these things. And this time around, if we do enter into a hard landing with a recession later this year, early next year, if that comes true, maybe they'll give us more time. And maybe they'll recognize how we can contribute to this economy that we've already been supporting. And look at the growth in small business since the Great Recession. Sure. It's really tremendous. It's really good sign. So, I think that everybody together in our discussions at Alpha, we were talking about, coming up with, through our industry, funding through our large independents, developing a fund at market rates, not free money, market rates for other smaller leasing companies that may need help, doing kind of a Warren Buffett, not a bailout fund, but a recapitalization fund where people have to pay market rates for it, but they deserve it through no fault of their own. They may have got caught up in this recession if it becomes a hard landing. So we've never had those discussions before, Jesse. I mean, in the Great Recession, we didn't know what was going to happen. So we were the uncertainty was at the highest level in my 40-year career. We weren't sure if the country was going to make it based on the failure of these large banks. But today, I think it's really important for all of us to look at this industry, recognize how far we have come. We have come so far from 40 years ago. We were absolutely a second, third tier business, tax-oriented business in the 80s. We weren't really recognized for value added in assisting small business. And we have made an incredible positive transformation over these last 40 years. And we just can't screw it up. We just got to retain our discipline, which I think we have. I think the capital markets respect us. I think our securitizations are still performing at this point, knock on wood. And as long as they continue that way and we remain disciplined and don't get beyond our skis, I think we can have a tremendous impact in helping small and mid-sized businesses.
No, that's, I mean, it's a lot to unpack in what you just said, but I mean, at the end of the day, we're a very resilient industry. There's always going to be some people that are flying by the seat of their pants or getting ahead of their skis, if that's appropriate. And, they might not make it through this, but, that's the nature of business. Was it you play stupid games, you win stupid prizes sometimes. So,
right. And you know what, Jesse, some of the most important lessons I've learned, are very simple, fundamental things. Like, for example, if it looks too good to be true, chances are it's too good to be true. So, when you get a great deal and it looks perfect, like the industry frauds that we've dealt with over the last 20 years or so, reassess it, get advice from other people, call your associates, take a look at it, have them take a look at it and give you an opinion. That's one thing. Again, I wouldn't be here without my mentors and my network and the associates. This industry is so unique, and it's unique because we support each other. And that's very unusual. I have to tell you, when I was in banking for 8 years at Continental Bank and then LaSalle Bank, it was a different environment. It was an environment where we were pretty much competing with each other, more than with other banks because we were the dominant banks. And the one thing that, I'm sure banking's better now than it was 40 years ago, but there was not the sharing of resources or picking up the phone and calling, one of your associates and say, hey, I can't figure this out. Tell me why I'm wrong. It wasn't anything like that. There was no free exchange of information. Everything was kept very close to the vest. And that's not our industry. And I think as long as we can, utilize and continue those skills, it's only going to help us. And of course, the biggest issue that I've always had, and one that I think accounts for the majority of our success as an industry, is something called skin in the game. Every time I had to start a leasing company, I had to put my own capital in there. These banks during the Great Recession, if you looked at the amount of capital or the stock ownership that they had in each of those trillion-dollar banks, it was a minority interest that has no meaning. And I've always thought that if a bank has trouble, the CEO and the executives should have real skin in the game to the extent that their cash investments are burned through first before stockholders take a hit. No one will do that. Okay, I understand that. No. I understand it's not realistic, but we're doing this every day. We as leasing, especially the independents. I mean, I'm owned by a bank now, so I don't own the leasing company anymore. But when I did, I was no different than anybody else. We had our own capital at risk, and when you have your own capital at risk, you tend to look at decisions much differently than if you're just a straight employee on a commission base. So I think that's what our industry has done so well. And even when you talk about commissions with salespeople, the one thing I really appreciate is the fact that those salespeople feel like they have skin in the game and they're out there collecting on those accounts. I think that's a great formula to have. You know, I don't believe in segregation of duties except for maybe operationally, but I do believe that, you know, if a salesperson earned a commission and that deal goes bad, the minimum they should do is assist in the collection effort. Maybe not be personally accountable, but at least assist or maybe have some at-risk position on their commissions. So we do a lot.
Because at the end of the day, that's their relationship, right? I mean, they're the ones that are establishing that with that customer. They need to, like you said, have skin in the game. It needs to hurt a little bit. Now there's also, I've been on that sales side too, where there's factors that you can't determine that impact some of those things, but that sucks. I mean, but that's the nature of sales.
That's okay. I mean, a commissioned salesperson that does not own part of the company also does not have the upside that the owners do. So, that's appropriate in many cases. It's just that, the salesperson knows the most about that account. And that's how you collect, is knowledge. And when you have that kind of knowledge and the relationships that debtor or lessee might have, the salesperson is invaluable in that regard.
Sure. No, absolutely. And then another point you've hit on a few times is the relationships that we have in this industry, and just like the knowledge transfer. I mean, you probably set that across the table from someone you probably just lost a deal to, and yet you're sharing, having that cocktail and just kind of sharing best practices, because that's the nature of it. You win some, you lose some, but at the end of the day, it's what can we do to be better as an industry? And that's like you said, I mean, it's not really common. From what I've seen in other industries, Dale.
Yeah, especially banking. Banking is just categorically different. And, I can't tell you how many times where I was competing with another associate of ours in the industry. And I just, usually it's because I can't get to the pricing. I understand credit really well, and we know how to structure deals extremely well and efficiently. But it's usually a pricing issue that causes us maybe to back off a little bit on a deal. But here's the thing, you know what? Their model is built differently than my model. So that's okay. And what happens is, inevitably, when that happens and you leave it on good terms with your associate, your competitor, something's going to come back to you in another deal, because they're going to find a deal that they can't structure or it's not within their credit guidelines, and they're going to call me on that deal. And so it goes back and forth, it's reciprocal. It really is. And I just have never seen it in any other industry, especially, the only other industry I was in was banking. And that stuff, you didn't even talk to your competitors. That was a rule that they didn't allow you to do. So, the sharing of helpful knowledge is really what this industry is about. And, that's why I love it. That's why I want to keep doing it.
No, absolutely. I mean, you do the right thing. Even sometimes, I mean, we're human. It's human nature, right? You want to make sure you win more than you lose, right? But at the end of the day, you do the right thing, and things will come full circle. Which, I mean, it's kind of hard for me too. I mean, I got in the industry in 2005, and I had two jobs before. One was retail and the other one was like a different sales job. So it's kind of hard for me to even relate that, but these are the reasons I love equipment finance and why I want this to be my forever home.
Well, I mean, Jesse, just look at what you're doing now through EFC. Look at all the information that you have gathered from all the people that you have interviewed, not to mention all the charitable efforts that you've done, which is a wonderful thing. That also reflects upon the image of our industry, and that's so important that, we show that we do care. And look at what we did, all of us did through COVID. We helped our customers out, we didn't pound on them and kill them. We actually assisted them, extended agreements and did all that. So, I mean, you're going to learn from what you already have learned so much from just interviewing people and the outreach on a charitable organization basis. There's no greater feeling than that, to help people out, and that's so important for any industry. And the more you do that, the more you publicize EFC and our other educational programs that we have in this industry. Sure. It doesn't just make you feel good. It makes us look more legitimate. So there's a dual benefit here that, I think everybody recognizes, including yourself.
Well, thank you. And I don't think about that as probably as often as I should. So I appreciate that. You bringing that up. It's refreshing. Because like, traditionally people just, oh, equipment finance or bankers, all you care about is making money and doing all these things. And it's like, actually, there's an ESG side to our,
Yeah.
community as well. And being given the ability to spotlight some of those initiatives to say, hey, yes, you need to have to give, that's granted, but we're also, this is our human side of our industry, and this is what we're doing to give back.
Well,
Is quite
exactly.
invaluable.
Let me tell you another benefit. I'm an older generation, no question about it. We had different rules and, the way to do business in the 80s and 90s. What you're doing with EFC and all these other educational programs, you're soliciting new people into our industry. And I don't mean, just younger people. You're soliciting all kinds of diverse groups of people into the industry.
Sure.
And if we want to flourish, we have to diversify on every level, and not just a financial level or an operational level, but interpersonal and social level. And these things are so good for everybody because they feel welcome. The last thing you want is to hire somebody that doesn't feel welcome into an industry. And let me tell you, the banking industry in the 80s and 90s, it was not welcoming. I mean, not just for women and every minority, but for me. I didn't feel that comfortable coming into Continental Bank, which was, a pretty well-known bank, and I'm a state school grad. I'm not a Harvard MBA, and that's what the culture was like. It was set up that way. So I know what it feels like, not to feel, welcome into an organization, but all it takes is time. You take the time to build a network and build the relationships, and you will garner more respect than you ever imagined. And that builds your self-confidence, and it builds your enjoyment in a job. So yeah, all these things, including what you do and what the other charitable organizations do in our industry, are just wonderful things that, you can't put a value on it. You know what I mean? It's really substantive and it's important.
Thank you, Dale. I greatly appreciated, sir. And I do want to ask a question. So, being an independent and then selling to a bank, right? I've seen it several times in my 18 years. What is that like? I mean, ideally, is that kind of the goal? You sit there and it's like, okay, this is what I've been able to achieve. What is my strategy here? And I kind of look.
It's a great question. It's a great question, Jesse. And let me answer, because I'm thinking of two different answers. Okay. There's pros and cons to everything. I'm going to start with this first. At Alpha, I was talking to Scott Wheeler, consultant for industry, and we're in total agreement. In the past, or the last, let's call it, I think Scott and I were saying about 5-10 years, 2/3 of the industry was banking and 1/3 was independence. Okay. We think that, I agree with Scott, that I think that's going to transform into a major change. I think it's going to invert. And Scott agrees with this too, that we're going to go from 1/3 of independence to 2/3 independence and 1/3 banks, because we're completing another cycle. And so I wanted to use this as kind of a prelude to answer your other question about what it's like working for a bank versus an independent. So I think the trend is good for people that want to start businesses in our leasing industry, because I think that trend's going to happen. It might take 5 years, it could take 10, but we're seeing it reverse. And part of it is because of the success of this industry. Okay. Not that banks are doing a bad job. I work for a bank, so, we're carrying our weight, but I think it's a great opportunity for people to start training themselves into thinking about starting a leasing company within the next 5 years. If you're going to do it, I think now is the time to learn, build your network, build your sources for capital, because the opportunities could come about just like it did for me. So now getting back to your initial question. So all it really depends upon is what you want to do. You can do either one, and when you're an independent, you have a lot of freedom. There's no question about it. It's a higher risk, of course. So when you're going from an independent to a bank environment, if you don't have prior formal banking background, it will be very difficult. And I'll just leave it at that. But, I was fortunate. I had a split. I had, 15 years, call it 15 years banking experience, and then, over 25 years in the leasing side. So I knew what to expect, but you need to remember that, a regulated environment is a much different environment than an independent environment. And I know we have more regulatory expectations going forward as an industry to protect small businesses, and that's okay. And we can do that. Even with the disclosure laws, I sit on the bank committee for Alpha, and the disclosure laws are really, I think everyone's concern about it is exaggerated, because, when customers sign our documents, they commit to a relationship. And all you have to do is explain why you're giving this disclosure document to them, which is for their own protection. And of course, they're going to sign it. So, and I know there's nuances beyond that, but my conclusion from the disclosures is, even though I'm not subject to it as a bank, don't sweat it that much, because you're demonstrating to the customer that you're helping to protect them as well. So there's no surprises down the road, and that's better for everybody. So, so that kind of regulation doesn't really, I don't think it'll have a material impact on anybody's ability to land deals at all, if you have a good relationship with your client. Now, going from an employee at a bank to what I did when after I started LaSalle and I started my first leasing company, Great American Leasing, what I do is I tend to phase risk. And when I say that, what I meant was, I was still pretty young. I was in my late 20s, I think, when I started Great American Leasing, or Galco, as we put it, not the company in Iowa. That's Tony's company, not mine, much larger company. What I wanted to do was have the benefit of becoming an independent and running a leasing company and having ownership without the full risk of having to put all the capital in. And so what I did is I hooked up at LaSalle. After I started LaSalle's leasing company, a customer approached us who had known me for quite a while. And again, that network building is key. And he was in the consumer finance business, financing crazy stuff, all regulated, of course, in the state of Illinois. But he approached me because his company was struggling because of the credit card competition. He couldn't survive. And this is in the mid 90s. So when he approached me, he asked me to start a leasing company for him to basically transform his consumer platform over to a commercial leasing platform. And that was in 1996. So the risk for me was very low, in the sense that, number one, I already had a capital partner. He was funding all the capital. I was a minority owner. I started out with, I think, 35% ownership, but I had the opportunity to become an equal owner over time. That was key for me. I wanted to be at least equal with him. And so he contributed all the capital. All I had to really do, it was a challenge, but it was very feasible. I didn't have to go out and hire 40 people. I had 40 people right there. My challenge was to retrain them in equipment leasing instead of consumer finance. So that's when I say phase risk, what I meant was, personally, I didn't want to put my whole estate at risk, but I wanted to take some risk that was reasonable based on production. And eventually I got 50% ownership of it. And at that point, I wanted to, that was actually when we were talking earlier in 2000, when this tremendous void occurred in the lower end of the middle market in 2000. And I wanted to go upscale from doing $15,000 deals to doing $250,000 size deals, which my partner had a heart attack over in the consumer finance business. So, what we decided to do was I sold him my interest in the small ticket leasing company. I used that money to start Cobra Capital in 2000. And I brought in my one of my former bosses from Continental, who's a brilliant accounting and tax guy. He was the CFO of Chicago Corporation, which became ABN AMRO's investment bank. But anyways, so when I started Cobra, even then, I phased in a little bit more risk. Yeah, I was personally at risk for half the balance sheet, and he was too. But at least I had a partner who I trusted and knew financial markets extremely well. And we were able to get our personal guarantee off our $10 million line with Cole Taylor Bank back then, who funded us as a startup. and we were able to get our guarantees off within a year and a half. And we basically sold off all our deals non-recourse and retained the servicing. So my personal philosophy, and I know not everybody wants to do what I do because it's relatively conservative. It's my accounting nature, I guess. I like to phase in risk gradually. So because I just don't want to fail. I mean, you know, I make mistakes like everybody else, but I don't want the company to fail. You know, there's too many people that have at-risk investments in the business for me to want them to fail. So that's kind of my personal style is, you know, I don't do anything dramatically. It's just gradual phase in of risk and reward. And, you know, that's one thing about our model has always been true. Every company I've been at, whether it was LaSalle, Galco, or Cobra, or Providence, it's all about the bottom line. We do not focus on the top line revenue line. We're not interested in becoming the biggest equipment finance company with 200 people. We like to keep it small, and we like to keep it simple, and we like to make a lot of money on the bottom line because it's what you take home after the end of the day, not how much revenue you have. That matters to me the most. So but I think the banking versus the independent, it's a transition. So, you know, if you don't have any banking background and you're running a successful independent right now, you know, you need to be cautious that it's going to be a change in culture. You're not going to be able to make snap decisions on your own. It takes time, and you have to develop patience. And trust me, I was not the most patient person as a younger individual, and I'm probably still impatient now, people would probably say. But you know, it's a different culture. Just prepare for the culture adjustment. And there's all kinds of things that I've learned about, you know, when you sell your company to a bank. So anybody out there that's listening to this, if you want some guidance and advice, you know, I can share that with you because that's the spirit of what we do in this industry. So call me if you know, are thinking about doing that and want some insight to somebody who's gone through it a couple of times.
Sure, absolutely. And you know, I guess I'm going to lighten it up just a little bit, if you don't mind.
Sure.
I ask everyone who comes on here to give them a little fun fact about themselves. So, what makes you tick outside of equipment finance?
Yeah, we're very active with our family. All our kids are athletes. My wife and I were athletes. My wife was the better athlete, by the way, than I was, both in high school and college. And it's great because we like to see our kids do it. So, you know, we love every sport you could possibly imagine. We like to remain active. And it's our kids that keep us active. They're all in their 30s now. And it's wonderful because all that time we spent with them in club sports and, you know, local sports and every sport you could possibly imagine, it's now coming back to benefit us because they're getting us out there to exercise more and get more involved in skiing and biking and boating and, you know, pretty much running and everything that you can possibly do. So I think, the payback has come back to my wife and I after, you know, 40 years of marriage here. Now we're the beneficiaries of 30-year-old wonderful kids that help us get active. So, you know, I think that's an important part of our social network too. A lot of our friends are a similar way, and they're all family oriented. We have a very unusual thing here in Downers Grove, Illinois. Nobody outside the country probably knows who Downers Grove, Illinois is, but we are in a very unique subdivision. When our kids were younger and we bought into a brand new subdivision, 20 couples all bought homes here with about the same age kids. None of them have left yet. And here it is, 40 years ago, right? So it's like, you know, when your kid is part of a sports team, you know, whatever it is, Little League baseball or gymnastics or whatever it is, and you click with those parents, it's a wonderful thing to experience. So, you know, we love our local community. We're very active in my wife's been a teacher here for 25 years. We go into grocery stores, you know, and every time we go into a grocery store, there's going to be a grade school kid that comes up and says, "Hi, Mrs. Kluga," and, you know, sometimes starts a conversation where the kid's parent doesn't even know who she's talking to. So, you know, it's a nice thing to share, and it's a nice thing to be able to say that. Because when I was growing up, it wasn't like that. You know, neighbors were friendly and all that, but no one hung out together for 20 years. That just doesn't happen. Everybody moves on at some point in life. So that's another unique thing I think that we've benefited from over all these years, and it just makes it so much more fun, you know?
Nope, absolutely, Dale. Thank you for sharing that. Thank you for sharing your insights today. For those people, watching this, if they need any advice or whatsoever, feel free to reach out to Dale. I'll tag him in this video.
Yeah,
But
please do.
I appreciate your time and insight, sir. Not sure when our paths will cross again. I'm assuming at some probably ELFA event or the next time in Chicago. But
Sounds good.
but thank
Yeah.
you again for joining me today.
Thank you, Jesse. I really appreciate the time.
All right, Dale. You have a good day, sir. Take care.
Okay. Bye-bye.